Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Cost Report Worksheet S-10, Audits and New Instructions. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F.
The presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. Today's webcast is eligible for 1.5 CPE credits. For the National Association of State Boards of Accountancy, to qualify for these credits, you must attend for a minimum of 75 minutes and respond to at least 5 of the 6 polling questions. And now that we have all the housekeeping items out of the way, I would like to introduce today's presenters. Mike Newell, partner at Moss Adams, Jonathan Mason, director at Moss Adams, and Heather Keser, manager at Moss Adams. All of their bios and contact information can be found in your webcast console. And now I would like to turn it over to Mike to get the presentation started.
Well, let's go ahead and get started, and thank you for that, Amy. First, let me also welcome all of you to our webinar today. We have a lot of material to cover and would also like to see if we can get in some questions at the end. While we've provided an S-10 audit update previously, we think this will be our most comprehensive to date, since this time CMS has mandated audits for all participants in the uncompensated care pool. So with that as our overarching theme, let's go ahead and talk about what we're going to cover today. While we won't spend hardly much time on the basics, we will begin with a brief update on the components of the uncompensated care payment formula. At this point, most people have a good understanding of how the program is put together, but there's always at least a few participants in our webinars that are new to the process, so we want to take a little time to do a brief overview. From there, we'll dive right into the audit results. Heather and Jonathan will walk us through the process from beginning to end and cover key aspects of what hospitals experienced during this last round of audits. Then we'll take a look at the data. We can see that the changes that occurred for about 1,500 or so hospitals audited, so it should provide us a good look at the trends and what actually happened to the numbers. We know there are more providers to be reflected in the CMS database after January 1st, 2021, and we'll get more visibility to those hospitals once their data has been uploaded into CMS's system. From there, we'll pivot to future reporting requirements. In the 2020 Federal Register, under the Paperwork Reduction Act notice, CMS proposed a whole host of changes to cost reporting and cost report instructions. And we're not planning to go into all of the changes, but we will focus on those impacting DSH and S-10. Now, there's a lot here, and we'll attempt to cover all elements. I'll encourage you now to review these changes for yourself and begin developing a process on how you're going to comply with them. And you'll see that a little bit later when we talk about that. From there, we'll just wrap things up. We'll leave you with a few closing thoughts, and if time permits, we'll get to questions. If there are questions left at the end of the session that we either couldn't get to or something we needed to follow up on, we will do so and reach out to you as soon after the presentation is possible. So let's go ahead and start with an overview of the uncompensated care program itself. The uncompensated care pool that qualified providers share in is derived through a calculation that involves several steps. The first step is the development of what is called Factor 1. Factor 1 is an estimate of what DISH would have been had the Affordable Care Act not been passed, minus what is called the empirically justified amount. CMS begins with several data points, including most recent cost reports and other actuarially determined data to project what DISH would have been in a particular payment year. Most recently, the estimates related to federal fiscal year 2021, CMS uses a starting point, the 2017 cost reports. So once the gross estimate is made, the 25% is subtracted. This is the empirically justified amount. And the remaining 75% is then used to continue through the calculation to make the final pool number. The 75% from Factor 1 is then adjusted by Factor 2, which is commonly referred to as the reduction factor. This factor is meant to estimate the level of uninsured in the country. In the initial years of the program, the data was derived through Congressional Budget Office estimates. But beginning in 2018, CMS changed the source of the data in an attempt to refine the calculation and reflect more current trends. And you may recall in this last round of notice and comment rulemaking, the provider community made a significant issue of this estimate in light of the ongoing pandemic and the trends in uninsured, and did this estimate accurately reflect the level of uninsured that hospitals would see in federal fiscal year 2021. Some changes were made to the estimate in the final rule that resulted in the increase of the pool. Once this step is completed, then the pool amount is set, and then from there, we go to Factor 3. Factor 3 is the topic of discussion for the presentation today. Once the pool amount is set, then there has to be a distribution method to allocate the dollars to qualified hospitals. Now, the distribution method is uncompensated care cost as reported on Cost Report Worksheet S-10. For this purpose, uncompensated care cost is the cost of charity care and non-Medicare bad debts incurred by the hospital. Each hospital shares in the pool based on its uncompensated care cost as a percentage of the total uncompensated care cost of all qualified hospitals. All three factors are developed and communicated to hospitals as part of the annual inpatient payment rulemaking cycle, which generally begins in April of each year and ends at the end of August or the beginning of September. The next cycle up will cover the federal fiscal year 2022 payment rates, and the Factor 3 to be utilized will reflect the results of the S-10 audits that are the topic of today's presentation. So with that as our background, let's go ahead and dive into the audit presentation. But first, I think we have our first polling question, so I will turn this back over.
All right, thank you. So our first polling question is, who completes your S-10 data? A, we do it in-house. B, we have a vendor, or C, NA. And we'll give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. And we'll leave this up for a little bit longer so that everyone can get their CPE credit. And we are having some people send their response through the Q&A chat, so just make sure that you respond on the actual polling question so that it records for you. Okay, here are the results.
So you can certainly see here that most people that have responded on this call are doing this in-house. We appreciate you participating today. I think as much information as you can get regarding the data that's required and the process CMS is going to go through in order to evaluate that data is critical, and especially when we get towards the end of this presentation and talk about what's going to be expected in future reporting. So great to have you here, and I hope this is of some benefit to you. So with that, I think we'll now turn it over and start talking about audits, and we'll turn this over to Heather.
All right, thank you, Mike. As the federal 2018 audits began, you can see on this slide items requested to begin the S-10 audits were similar to the federal 2017 request. The standard letter requests a copy of the financial assistance policies, the financial statements, working trial balance, as well as the bad debt reconciliation between the bad debt on line 26 and the financials. They also requested a detailed listing of transaction codes and descriptions that detailed behind the lines 20, 22, and 26, as well as the detailed logic on how the facility prepared the S-10. As the 2018 audits began, listed here on this slide are a number of items that the auditors review before selecting a sample. Policies are being reviewed more in depth and even questioned by auditors. Hospitals are having to provide additional resources as how certain charity transactions and programs that are reported on their charity section of S-10 may have been covered in their written financial assistance policy. Every hospital needs to review their financial assistance policy and other policies where they are granting discounts and really look at the language and how it's related to the S-10 instructions and try to put yourself in the position of an auditor reviewing your policy for the first time. Are the policies clear, and do they accurately represent the discounts you provide at the facility? And do the eligibility requirements and documentation items needed to approve charity represent the day in and day out operations at your hospital? It's also important to be aware if your policy states a specific percentage should be given that the patients receiving charity or uninsured discounts are actually receiving the same percentage as the policy. We have seen in many cases where providers offer a 50% uninsured discount in the policy, but when reviewing the percentage of the discount applied to the account, it could be a greater percentage than the policy stated. This puts the facility at risk for extrapolations. As we cannot stress policy review enough, there was a hospital that had self-pay discounts disallowed on the S-10 as it was not covered in their financial assistance policy. The self-pay discount was under an administrative manual and not the FAP, which the MAC argued the discounts was not properly accounted for in their FAP. There were arguments as to CMS came back and clarified self-pay discounts or uninsured discounts can be included as charity on Worksheet S-10, but given that this was not a separate policy or in their financial assistance policy, it was then disallowed. As auditors begin reviewing the patient-level detail provided for the audits, they're identifying what they call duplicate accounts. There are questions of duplicate accounts between the uninsured and insured listings for charity and the charity and bad debt listings. For example, a patient can receive charity discount that is greater than the coinsurance deductible and copay. As the instructions state for insured charity, you are to only report coinsurance and deductible in column 2. Any discounts greater than those amounts would be related to non-covered charges, which are then to be reported in column 1. This was a tedious task to explain this to auditors, as hospitals had to provide remittance advices and EOBs to show the dollars were not true duplicates between the listings. As far as duplicates between charity and bad debt, a percentage of a charity discount could be applied to an account, whereas the remainder of those charges could also be written off at a later date. For example, if a patient has total charges of $1,000 and an uninsured discount is applied for $600, you would see the $600 reported in the charity section. The patient responsibility on the account is then left at $400. If your patient does not pay and the hospital follows the collection policy, the $400 could end up in bad debt. These would not be duplicated charges, but again, full account histories showing full activity on the account was provided for proof. Now, Figliozzi, the subcontractor that handled a large number of these S-10 audits, spent a considerable amount of time looking for the insured charity listings to ensure that all insurances included as insured had a contractual relationship with the facility. For insurances such as auto insurances or workman's comp, these were being reclassed to be included in the uninsured column. The S-10 instructions state that patients with coverage from an entity that does not have a contractual relationship with the provider should be reported as uninsured. Now, during this round of audits, the MACs provided templates for hospitals to populate the requested items for the patient-level detail for charity and bad debt. The biggest issue when populating these templates was explaining to the auditors that accounts may not reconcile properly. This was due to the cost reporting instructions, which state to claim charity and bad debt based on write-off dates, whereas when the data for the templates were created, there could be activity that happened after the cost reporting period. At times, charity discounts can be reversed in the future cost reporting period when completing the template. It may look like the account does not tie out properly. For example, if a patient received a self-pay discount in the current fiscal year, but then was deemed to have an insurance in the future cost reporting period, it could potentially show the reversal of the self-pay discount and an insurance payment. Auditors were wanting to remove the self-pay discounts on the cost reporting period, but really they shouldn't, given that the reversal would be captured in the future cost reporting period. So to go into more detail on reconciling of the accounts, here on this slide, we have provided a formula in which the auditors were trying to reconcile the detailed listings provided. Total charges, less payments and adjustments should equal the charity write-off. As Mike will discuss later in the presentation, this reconcile will be used in preparing the S-10 for the future cost reporting periods. You can see that account 1 reconciles correctly and has a variance of 0. For account 2, you can see the variance left on this account is positive. This could happen where the accounts may still hold an account balance that would result in a positive variance. Majority, if not most, auditors accepted that accounts can still have balances remaining on these accounts. Now for account 3, there could be a number of reasons this account ties to a negative balance. The first obvious reason would be that the facility wrote too much off to charity, leaving the account with a negative balance. This is why the auditors are ensuring that the accounts tie out, because when they see negative balances, their first instinct is to reduce the charity write-off amount for this account. Another example could relate to accounts that were written off to charity or bad debt during the fiscal year, but additional activity happened on that account in a future cost reporting period. For example, if an account was given a self-pay discount for the current fiscal year, but was later deemed to have insurance and the insurance provided payment, the self-pay discount would then be reversed on the future cost reporting period, but during the time frame of the cost reporting period, the account would have just tied out. Another example for account 3 is if an account was written off to bad debt, but then later the patient came back and made payments towards the bad debt amount. These would be identified as recoveries. During the time frame of the cost reporting period, the account would have tied out just fine, written off to bad debt, but at the time of the data pull after the fiscal year end, these patient payments would have made it look much more like written off to bad debt, therefore causing a negative balance. Just a reminder that charity care and bad debt write-offs should only be identified by the year they were written off and for the amount claimed on Worksheet S-10. So moving on to how to handle multiple write-offs. So many times an account has multiple write-off dates. In addition, they could span across multiple cost reporting periods. For the audit template request, each patient account recorded should be summarized. It states to roll up each account into one cohesive horizontal line of data. Vertical detail items such as revenue code detail and multiple write-off dates should be reported on supplemental listings and relate back to the horizontal summary via the unique encounter number. For the example shown here on the slide, we would expect to see $500 in charity care for 2018. And then we would expect to see $1,000 for charity care in 2019. In addition, a separate tab in the workbook, auditors would want to see the detail behind those totals as illustrated above. The detail should tie to the total. As you can see on the last two slides, populating these audit templates can be very time-consuming. So I will now hand it back over to Amy for our next polling question.
All right, thank you, Heather. So our second polling question is, how much time do you estimate you spent supporting the 2018 S-10 audit? So your options are A, 5 to 10 hours, B, 10 to 20 hours, C, 20 plus hours, or D, NA, or I don't know. And I would like to take this time to remind you to submit your questions for the presenters in the Q&A window. And if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. I'll leave it up for about 5 more seconds here. All right, here are the results.
So it's not surprising that, go ahead, Heather.
Oh, as Mike was about to say, yes, it's not surprising that majority of the people on the call today has spent over 20 plus hours. We spent a considerable amount of time just on the audit templates and the audits alone. So moving on, we're going to continue with the 2018 audits. There were a number of hospitals that received a questionnaire, which we're about to dive into. We believe that this questionnaire was only sent out by one MAC during the 2018 audit, but now that we have started receiving some audit requests to begin the federal 19 S-10 audits, this questionnaire appears to be used by more than one MAC. Yes, that's right. The federal 2019 audits are already getting started. So let's take a look at the questions and how they should be answered. For the first question, how did you generate your listing to ensure that it only includes charity care amounts that were actually written off to charity care in this cost reporting period, regardless of when the underlying service dates were? Jonathan?
Yeah, I think there's a good reason they start off with this question, because if you don't have your detail assembled correctly, then everything else doesn't really matter. You know, charity is to be reported by write-off date and not the service date of the patient. And while I think most hospitals know this, as S-10 instructions were updated, I think back in 2017, we've seen more examples of hospitals claiming charity by write-off date, but also setting a criteria to include only service dates that are within the hospital's fiscal year. And so obviously doing this severely reduces your claimed amounts, which is obviously not in accordance with S-10 instructions. Now, kind of as part of the 2018 audit, some MACs wanted the detailed scripts used to generate the charity totals on S-10, while others allowed kind of a detailed explanation of how the charity was compiled so that they could determine that the charity was reported correctly. So both the scripts and the detailed explanations of those scripts should be ready if asked during these 2019 reviews.
How did you ensure that no charity care was duplicately written off in the current year and in any prior years?
Yeah, as you covered earlier, Heather, duplication checks were a big point of emphasis during these reviews, and it looks like that'll continue for these 2019 audits. I think one thing about duplication checks is it can be very difficult to tell between a duplication of the same charges and just separate write-offs for different parts of the bill. And this can be difficult for the provider to determine as well. So I think that's where this question stems from. They're wanting to know how you check for those duplications, especially if you have write-offs for the same account that span multiple fiscal years. So they want you to articulate how your hospital grants charity. You know, it wouldn't surprise me at all if the 2019 audit protocol used the patient detail from the 2018 audit to check for duplication, as the MACs will have the 2018 reported values for all DISH eligible providers. You know, hospitals will need to make sure that they are checking for duplication within the year, but also between the 2 years to ensure there are no findings in this area.
What transaction codes are used in your operations to identify charity care write-offs versus other contractual adjustments?
Yeah, I think a lot of MACs during the 2018 review wanted a transaction key with all of the hospital's transaction codes and descriptions for each code. Now, most hospitals can supply this list and identify where on their general ledger kind of these transactions are mapped to. What this question doesn't ask, and it's something that then comes up after you supply this list, are questions regarding those charity transaction codes and where they are included in your written financial assistance policies. This is where the hospital can be subject to some audit risk if they are not, if they have not completed this step when preparing their detailed logs. As we've seen, it's not every transaction code is mapped to a charity GL account, and that's not always covered in your policy. You know, while listing these transaction codes in your policy is kind of never recommended, as systems and transaction codes can constantly change, providers do have to be ready to defend your charity transaction codes and to be able to show where in the policy or policies they are covered. This is especially true when so many of the auditors currently reviewing S-10 are new to the cost report page and new to reviewing financial assistance policies. If this question doesn't come up as part of an overall review of your transaction codes, it'll certainly come up when during a sample during the sample of the charity accounts, where you'll have to support how this account qualified for a charity discount based on your written policy. And then you'll have to provide the support that allowed you to come to that determination based on the parameters spelled out in that policy.
What methods are used to ensure that there were no claims reported in both the charity care and bad debt listings?
Yeah, this on the surface is a simple question, but it goes back to a question we discussed earlier. You know, at many hospitals, there will be duplication of patients in both charity and bad debt, but it will need to be conveyed after completing the review of the data that there are no duplication of the same charges. You know, during this past round of audits, we spent a considerable time walking through examples of these types of records with auditors to show that these were not duplicated charges. There are many instances where a patient may receive a partial charity discount and then have the remaining balance recorded as bad debt and can be included in the bad debt listing. I think the question you'll have to answer is how you determine that these were not the same charges. Now, our audit support team and several audits had to work with the auditors to reverse multi-million-dollar adjustments that they were about to make when reviewing these accounts that kind of at first glance appear to be duplicated.
Do you have any Medicare patients that are reported on charity line 20? If so, how do you ensure that these amounts were not already written off as Medicare bad debt?
Yeah, this goes along with the last one, and I think there are a couple of reasons why it's a separate question. I think the first being that duplication within Medicare bad debt and charity can happen quite frequently based on the Medicare bad debt that the hospital is claiming. So it's a much more common occurrence to have true duplication of charges between charity and Medicare bad debt. I think the second reason is because of the timing on when Medicare bad debts can be claimed. You know, you may have to answer how or why a patient's charges that are written off to charity with a Medicare Part A payer are not claimed as a Medicare bad debt. And then also be able to answer how you can ensure that these claims that are currently being counted in charity will not be written off to a Medicare bad debt in a subsequent year. So the whole purpose is that the MACs are attempting to make sure that the same charges are not being counted twice in the hospital's total uncompensated care, whether that's within the same year or over multiple years?
All right, the next two questions go together. So does your policy discuss allowing charity care approval for amounts related to insured patients that have exhausted their benefits? And does your policy discuss allowing charity care approval for amounts related to non-covered services?
Yeah, there's a couple points on these two questions. The first having to do with your charity care policy. We always recommend that every year you review your policies so that you're proactive with these types of questions. Is it clear in your policy that you grant discounts for patients who have exhausted their benefits or have non-covered services? If it's not clear, we recommend you consider revising the policy to avoid any issue at audit. If you're claiming these exhausted benefit charges or these medically necessary non-covered charges, how does your facility separate insured versus uninsured write-offs? Is your hospital drilling down to the coinsurance, deductible, and copay amount on each claim to understand what each charity discount is covering? You know, without drilling down to that EOB level, it's very easy to claim write-offs as insured when really those are exhausted benefit or non-covered charges that need to be captured as uninsured. And to those that may not be in the details of S-10 reporting as others, the reason it matters so much is that the insured charity write-offs are not subject to the cost to charge ratio, while the uninsured discounts are subject to the cost to charge ratio. So in most cases, it makes significant difference to the overall charity cost depending on what bucket you report these write-offs in your S-10.
Does your policy discuss allowing charity care approval for amounts related to services for patients with coverage from an entity that does not have a contractual relationship with the hospital?
Yeah, so here's another question that ties back to your policy. Is your policy clear that you can grant discounts for non-contracted payers? If not, then you may need to consider revising your policy to make that clear. We run into this quite frequently where hospitals have a hard time tracking down the list of contracted and non-contracted insurances, especially during the time constraints of an audit. So if you don't have one readily available, we recommend the hospital create one and monitor this file to keep it updated based on new information. You know, it can be very easy to mistakenly claim a charity write-off as insured after a non-contracted payer pays a portion of the claim. But these charity write-offs should be reported in the uninsured column per S-10 instructions. So this can come up during audit sampling, and then at that point, the hospital is at risk for large extrapolations if it's determined the write-off amount is in the wrong column or category of charity.
What methods are used to identify patients with Medicaid or other indigent care program coverage that exceeds the length of stay limit?
Yeah, so instructions call for Medicaid non-covered charges related to length of stay limits to be recorded in column 2, but also in line 25 of S-10. And so the reason this is important is when you report these totals in line 25, the amounts are subject to cost to charge ratio, just as if they were in the uninsured charges category. So this gets back to your patient financial system and how you extract the data from that system. Only these length of stay limits are to be recorded on line 25. And kind of one of the things to remember that really isn't mentioned in this question is that these charges can only be recorded as charity if they are first included in your written financial assistance policy. We still see a number of policies that are silent on this type of discount, and then we see others that really struggle in extracting this specific information from just the typical Medicaid contractual adjustment on any given account.
Have you included any amounts related to self-pay discounts for uninsured patients?
I think it's interesting they single this one type of discount out, but probably not totally surprising, as we see a lot of issues with this type of discounted audit. You know, all discounts claimed on S-10, including self-pay discounts, must be included in a written financial assistance policy. We have seen where patient financial systems automatically write off a portion of the charges once the patient is deemed uninsured in the system. However, there's no written policy that explains this discount. I think even more frequently, we've seen these discounts not in the charity policy, but in another document where it's not well described the type of discount and the parameters when a patient may receive this discount. We've also actually seen many examples of a self-pay policy that would seem to indicate that it's a form of a prompt pay discount, which is expressly prohibited to be claimed on S-10. However, with some of these hospitals in actual practice, there's no requirement of payment to receive that discount. The point is that the self-pay write-offs need to be defined in a policy, and it needs to be clear how a patient is eligible for the discount. What the discount can be applied to, kind of meaning, is it just fully uninsured patients, or can non-covered charges after insurance activity be eligible for the discount? All of these things need to be clearly defined so there kind of are no interpretation issues of your policy at audit.
How did you ensure that no physician or professional services were included in the charity care listing?
Yeah, virtually all the 2018 audits allowed hospitals, kind of where applicable, to attest that professional charges were on a separate system than hospital-based charges. I think in those cases, charge detail wasn't required as part of the audit. However, many systems do commingle professional and hospital-based charges. And what we've noticed is that in many cases, there's a belief by the hospital that there's virtually none or very little charges wrapped up in charity or bad debt write-offs. What we've seen, though, after pulling charge detail to support the audit, is that this is not always the case. Hospitals will need to accumulate all charges by revenue code for a given patient and separate the hospital and those pro fee charges to make sure pro fees are not included in the S-10 totals.
On the Total Charity Care tab, the total charge column should equal the sum of the total patient payments, total third-party payments, patient charity care, and their other contractual amounts columns. Are there any instances where this is not the case, and if so, please explain.
Yeah, this goes back to what, Heather, you covered earlier, and kind of was a point of emphasis during these reviews, that all accounts tie out from total charges less all activity to the patient's accounts balance. So by doing this reconcile, if there was a negative calculated balance, the auditor's first thought was to remove that negative amount from the charity write-off claimed. The problem is the issue is not always with the write-off and can be one of the other fields in how the template was populated, as you went over a few examples that can cause issues when attempting to populate the template. Time must be spent before providing any template to the auditors, as these accounts must reconcile or you run the risk of adjustments to your charity totals.
How did you ensure that S-10 line 20 column 2 only contains the deductibles, coinsurance, and copay amounts related to insured patients and not any charges or other amounts for those patients?
Yeah, so we're seeing a theme here where separating and correctly identifying true insured charity discounts versus other types of uninsured discounts, as some of the last several questions have been variations of the same statement. Hopefully through this exercise, you see how important it is to distinguish these amounts, as during the audit, you'll have to explain all the processes that you put in place to accurately capture these two buckets of discounts.
Do you employ the use of a presumptive eligibility tools to determine charity care qualifications?
So I think there's probably a couple reasons they put this question into the questionnaire. For one, auditors want to know which accounts won't have a financial assistance won't have a financial assistance application, and that typical underlying support, kind of such as pay stubs, W-2s, and other items in order to qualify the account for charity. This is just another question that goes back to your policy, and every hospital needs to make it clear what kind of presumptive eligibility tools that you use and how these tools identify indigence and eligibility for a charity discount. Policies that are not clear run the risk of different interpretations by their MAC on what is needed to grant charity. And so this can lead to issues at audit during sampling. And we've seen this firsthand with problematic policies that don't articulate kind of the qualifying factors for some of the various categories of charity eligibility.
Are you aware of any claims that were reported on your original S-10 that were inappropriately included in the uninsured columns that should be removed to insured, insured to uninsured?
Yeah, this one's a little interesting in that it's just double checking with the hospital to make sure they don't have any additional changes that need to be addressed. You know, I've already spoken to one MAC who had stated that they expect changes from the 2019 as filed amounts listings prepared for the audit. You know, this is especially true when a good number of providers filed before their 2018 audits were completed. You know, they know that hospitals, just like the MACs, are still learning. And I think one of the largest areas of concerns for MACs, and you'll see this play out in the HCRIS results that we'll cover later, is making sure you've accurately reported whether the discounts that you are granting should be in the uninsured or insured column of S-10.
So how did you ensure that patient payments reported on line 22 are only those related to a charity care amount that was written off in a prior cost reporting period?
Yeah, this note's just making sure that hospitals are following the current S-10 instructions that just call for you to include payments only associated with charges that were previously given a charity discount. This is not an everyday occurrence, so in most cases, the hospital's line 22 amounts are relatively small. But from our experience and what you'll see from the audit result, there are still many hospitals that appear to be reporting too much in this line, and this only decreases your overall uncompensated care. You know, these dollars, again, are not subject to the cost to charge ratio either, so it's very important to only count the dollars associated with a prior write-off and not just payments for something still owed by the patient.
Does your policy discuss the treatment of patient payments that are sent in for an amount that the patient is no longer liable for due to it being written off to charity care?
I think this is a follow-up to the previous question. You know, a lot of policies explicitly address that when a payment is received from a patient who is granted charity for the same dollars, that payment will be refunded, or the payment will be refunded to the patient. One of the items they're looking for that will strengthen the argument that line 22 should have very minimal amounts, if any, is if the hospital can point to their policy where it states that these discounts will be refunded. If the MAC can see that in your policy, then they know that this line 22 should be extremely small, if not zero, depending on the situation.
Moving on to the bad debt section of the questionnaire. How did you generate your listing to ensure that it only includes bad debt amounts that were actually written off as bad debt in the cost reporting period, regardless of the underlying service dates? And are there any Medicare bad debts reported in the total on line 26 that are claimed in a different cost reporting period for Medicare bad debt reimbursement purposes?
Yeah, so as we kind of switch to the bad debt questions, just like charity, we start with the foundational question to make sure that you're reporting your bad debt correctly on write-off and not service dates. I think the second question stems from the fact that the MAC and in turn CMS are aware that there can be different reporting requirements and timing differences between total bad debt and Medicare bad debt, and they want to know how the hospital handled these situations. For instance, do you have accounts that are written off to bad debt, kind of which I'll define as amounts removed from active accounts receivable and placed in bad debt, that are then claimed as a Medicare bad debt in a future fiscal year? You know, for example, do you have traditional self-pay Medicare accounts where their patient responsibility was written off to bad debt in one year, but claimed as a Medicare bad debt in a future fiscal year when the claim was returned from the collection agency and deemed uncollectible? You know, if the hospital's not careful, these same charges could be claimed in 2 subsequent years, and the MAC is inquiring on how you prevented this type of occurrence from happening.
How did you ensure that no bad debts were duplicately written off in the current year and in any prior years? What transaction codes are used in your operations to identify bad debt write-offs versus other contractual adjustments?
Yeah, I won't go into too much detail on these as we kind of already covered these same questions in the charity section. I think the thing to point out, though, is that depending on the patient financial system, it can be virtually impossible to use transaction codes to identify bad debt write-offs. The hospital needs to determine when the account is removed from active accounts receivable and what caused this change in status in their system. It's not always a transaction code, but can be a system adjustment or a status flag that triggers the write-off that causes the activity in the general ledger.
So here we have, explain how the total bad debts reported on line 26 reconciles to write-off derived from the accounts receivable balances on your financial statements or working trial balance.
Yeah, so on this slide, this is just one of the examples we've seen in regards to bad debt templates that a hospital can use to reconcile the provided bad debt detail recorded in line 26 to financial statements or that working trial balance. I think the main takeaway is that the auditor is looking for actual patient detail that led to a reduction in accounts receivable for the fiscal year being audited. A hospital can get into trouble when they start reconciling to their provision or certain reserve totals that is not necessarily what was written off to bad debt in that year. Now, this is a very simple example and doesn't go into the complexities of attempting to reconcile year-over-year changes in the hospital's accounts receivable. You know, in most cases, more lines and more explanation will need to be given when attempting to reconcile year-over-year AR changes. There's also a lot of things to consider when populating a template like this in regards to how the hospital handles post-write-off activity. You know, does line 26 account for activity where insurance adjustments are applied to a patient while the account is in a bad debt status? You know, how are these adjustments considered in your detailed listing? How is this accounted for on your reconcile? Kind of where do you include certain Medicare bad debt that during this time period may not have been written off to a bad debt account? You know, some hospitals start with attempting to reconcile their bad debt allowance account, as these bad debt roll forward work papers are typically something that a controller may already have prepared. Some auditors will not accept just this roll forward, but will need this AR reconcile. I think either way, the point is that this should be a required step when we're preparing your S-10 for filing, and certainly well before the audit start. What you don't want is to find yourself in a situation where you complete this reconcile and have material variances between the patient detail that you recorded on S-10 and this reconciled total. These variances will have to be explained before they can move forward with the audit of your bad debt. Or the MAC might move forward with your bad debt portion of the audit, but if the reconcile back to the financial statements is less than the detail, you may be held to that lower total.
Some overall questions. If the listing that you are providing does not correspond to the amounts you originally reported on the various lines of S-10, please provide an explanation as to why the amounts have changed. And feel free to provide any further explanations you believe may be helpful to the auditor reviewing your listing.
Yeah, the only thing I'll add for these last two questions is from our experience and what we've heard from auditors already is that they're expecting changes from the filed S-10s to what is prepared for this next round of audits. And so the hospital or their consultants will just need to explain the reason for these variances. And now I think Heather will jump back into the samples from the audit and those results. But I think before we get to that, I think Amy, it looks like it's time, I think, for our next polling question.
All right, so our third polling question is, with the pandemic and the recent S-10 audits, are you planning to revise your financial assistance policies in the near future? Yes, no, or NA? And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 5 of the 6 polling questions. And we've had quite a few people asking if the webcast will be recorded and available, and the answer is yes, and we will be sending that out to all attendees tomorrow, along with a copy of the slides. All right, we'll leave this up for about 5 more seconds. Okay, here are the answers.
All right, it looks like we have about, go ahead.
Go ahead, Heather. No, so go ahead.
Yeah, I was just going to say it looks like we have about a 50-50 split here between the people that said that have financial assistance policies to review, and I'll just reiterate what Jonathan mentioned. That's going through this questionnaire. The policies are pretty much the key holder with these audits, and having MACs to understand them and identify them to allow that you're properly reporting your charity care as you should be. So with that, we'll move on into the detailed samples. Here on this slide, you can see that there is a variance of how MACs treated the sample sizes for charity. The chart shows a range of numbers of categories and the total number of accounts that were sampled. Some MACs set their criteria on uninsured and insured claims and further separated those into inpatient and outpatient accounts. High and low strata based on the individual charity write-off amounts claimed on S-10. And then the opposite end of the spectrum, one subcontractor who handled these reviews for several MACs pulled only 8 accounts for their entire sample. I'd also like to mention that the sample sizes was not dependent upon the hospital size. Now moving on to the documentation requested for these samples, generally the same documentation is being requested for each sampled patient as this falls in line with the sample request we saw for 2017. UBs were requested verifying the patient charges and to verify that proceeds were excluded from the claimed amount. Patient account histories were also requested to verify the claimed charity write-off amount matched the patient financial system. Auditors also requested the charity care applications and approval forms, as well as any underlying support detailed in the policy necessary for a patient to qualify for charity. And for patients claimed as insured charity, the MACs also requested remittance advices and EOBs to verify that only charity discounts related to patient responsibility amounts were included in column 2. One thing hospitals need to keep top of mind when migrating to a new system is to make sure the data elements can still be retrieved. As we've seen, hospitals really struggle with retrieving documentation from an archive system. So to jump forward to the notable audit findings from these samples, as I mentioned on the previous slide, most auditors requested that all of the documentation be required per the policy to grant a patient charity care first applied during audit. Depending on the hospital's policy, this may include W-2s, pay stubs, bank statements, basically any and all items spelled out in the policy required to grant charity. If the policy stated that the patient must have 10 specific documentation items to qualify for charity, the MACs were requiring that all 10 items be supplied during the audit to determine if the policy was correctly followed. Any lack of documentation led to audit findings and the potential for large extrapolations. And for hospitals that grant discounts based on presumptive eligibility scoring models, perhaps by an outside vendor, the MACs required some type of score sheet or approval sheet showing that the patient qualified for charity. It was not enough to supply a patient account history with a presumptive charity discount. We saw hospitals struggle to obtain this documentation timely with their outside vendor if these sheets were not kept internally at the hospital. And again, any lack of documentation would lead to an adverse audit determination. Continuing on to the sample findings, another noteworthy item found during the reviews was that insured discounts claimed in column 2 were not always related to coinsurance and deductible as per the S-10 instructions. After reviewing the remittance advices and EOBs, charity care write-off amounts were determined to include insurance denial charges, non-covered charges, or even limited benefit charges that should have been reported in the uninsured column. And for uninsured discounts, it was found while reviewing the UBs that not all total charges matched the write-off amounts for uninsured claims. An additional issue that hospitals need to be aware of when hospitals are combining charges for multiple accounts into one single account. We saw this come up during review, and it made it very difficult for hospitals to obtain the necessary documentation for each pre-merged account to satisfy the audit request. So moving on to bad debt, every MAC pulled a sample of the accounts from bad debt. As you can see on the chart, similar to the samples pulled for charity, the bad debt samples range from different sample sizes per MAC. Within the template provided by the MACs to populate bad debt detail, it was requested to identify accounts included in the bad debt listing as uninsured or insured. Some MACs pulled samples by these individual categories as well. Similar to the documentation requested for charity, UBs, remits, EOBs, and the account histories were also requested. Now on this slide, I've listed some of the findings for the bad debt reviews, and I'll just briefly discuss a few of them. We saw accounts that were not properly given a self-pay discount after insurance recouped their payment. We also saw reversals of bad debt write-offs did not always use the correct associated bad debt transaction code, and therefore the bad debt detail was overstated. And some hospitals were unable to supply remittance advices for legacy accounts from previous systems, and auditors removed these amounts for not having proper documentation and then extrapolated the results. Also, during the review of the sampled bad debt accounts, there were some instances where hospitals stated bad debt recoveries were included in the bad debt listings, but really, when the support was provided to the auditor, you could see that the write-off amounts did not include recoveries. Some auditors allowed providers to supply additional listings for recoveries, but in other cases, some auditors just chose to apply extrapolations. As Jonathan mentioned earlier, there are timing differences between total and Medicare bad debt. For example, if the traditional self-pay Medicare account where their patient responsibility was written off to bad debt in 1 year, but claimed as Medicare bad debt in the future fiscal year when the claim was returned from the collection agency and deemed uncollectible. Line 26 states to only include those write-offs that occurred during the cost reporting period. Consistent with the prior S-10 audits, the findings of the charity and bad debt samples, no MAC or auditor handled the findings the same. There seems to be no set guidelines on how to handle any of the sample findings and how to apply the errors to the populations. Depending on the errors, some auditors chose to extrapolate across the entire population, and some MACs only chose to remove particular errored accounts from the charity instead of extrapolations, and this goes back to sample sizes also. It was also very apparent that a number of auditors handling these S-10 audits were fairly new to auditing. Dealing with the auditors and the lack of knowledge about S-10 required us to spend more time with auditor supervisors or even the MAC directors. As I mentioned before, Bibliozzi handled a large number of these S-10 audits and also pulled the smallest sample sizes. They were also the ones to actually ensure that the charity and bad debt listings that were provided reconciled from the total account balances. We've covered a substantial amount of information, so just to quickly recap these audits. Worksheet S-10, charity and bad debt included in the filed reports must be supported by patient-level detail, and the hospitals must be able to provide documentation for each sample charity patient during the audit that verifies that the patient met the criteria stated in the hospital's written financial assistance policy. Small sample sizes have the potential for large extrapolations, so we recommend that every hospital complete an audit readiness test to determine how they would fare when their hospital is audited. I think each hospital should review their financial assistance policy to ensure the write-offs that are being included on their S-10 are actually covered under their written policies. After hearing the summary of the 2018 audits, how do you think your hospital fares in terms of being audit ready for these upcoming 2019 audits? And with that, I will hand it over to Amy for our next polling question, and you will hear back from Jonathan.
All right, thank you. So for our first polling question, we're going to keep this up while we address some of the Q&A that's in the inbox. So go ahead and answer that. Your options are below, and we'll keep that up there to give you time to respond while Mike jumps in with some of the Q&A.
Jonathan, we've had a couple of questions. I think there's still a little bit of confusion because there was a change in the instructions regarding what gets reported on line 20, column 1, whether it's total charges or the amount of write-off. Do you want to talk about the change in instructions that covers that item?
Sure, yeah. So there was a change in the instructions, specifically, I think, where we've seen some hospitals not totally understand is the part where charity, which in precaution reports beginning on or after, I believe it was 10/1/16, charity is to be recorded by write-off date, but also by just the amount that was written off. So it is no longer the previous instructions which called for you to claim the full total charges of a patient, regardless of the percentage of charity discount that you gave. So that's a big change. And so obviously the years that were under audit, these federal 8 teams, well, under that new instructions where you are only to be claiming the write-off amount.
All right, and here are the results to that polling question.
Yeah, and I can jump in here. So this isn't surprising that it's kind of a good mix. You know, a lot of hospitals, obviously the federal 18 were the first year that had every DISH eligible provider being audited, while the previous rounds, it was only a select few, 25% around. So to now go through the experience of the audit and kind of looking forward to how your 19 and future years are reporting, that be somewhat concerned is probably what we would expect to see. And so I think we'll jump into kind of the HCRIS analysis. And so as we move forward, you know, Mike discussed earlier these 2018 S-10 audits that were just finalized will presumably be used to calculate a hospital's UC payment for the 2022 calculation. And as the fourth quarter of HCRIS was recently published, we think it'll be very beneficial to spend some time reviewing the results of these audits to see the impacts that these reviews had on providers' S-10 totals. And so we'll highlight any trends we see and then take a closer look at what kind of impact these revisions can have on a hospital's federal UC payment. So the analysis we're presenting today from HCRIS is the change in federal 18 S-10 cost reports that occurred between June and December 31st, 2020. So this is the time period that these audits were being conducted and many were finalized. And so we set our criteria on all hospitals that are projected to qualify for UC reimbursement based on the 2021 rule. We know that every DISH eligible provider plus sole community hospitals were audited during this last audit cycle. And so you can see on the slide, we're showing 1,539 providers with revised S-10 amounts loaded into HCRIS during the second half of 2020. The reason we don't have the full listing of audit results is because these audits that were set to be completed by the end of last year actually continued into January for a good portion of the hospitals. And so the results of those audits will not be released into HCRIS until after the first quarter of 2021. But as you can see, we have around 65% of the DISH eligible hospitals for that 1,539 providers with those S-10 findings. And so for these around 1,500 hospitals, that line 30, which is the sole data point for calculating the hospital's UC payment, decreased by about 4.7%. And so that's over $1 billion in UC costs removed from these S-10 reports. And so now let's dig a little deeper into what made up that $1 billion change in UC costs. You know, here we're showing the change in line 20 charity care charges. And as you can see, that 1,393 of the 1,539 cost reports had updated charity totals. You know, collectively, just over $206 million was added to the uninsured charity for these hospitals. And as you can see, as a percentage of the total, that's an extremely small change of less than 0.5%. The biggest change I'll highlight from this slide was the decrease in insured charity charges by over $1 billion, which equates to a 27% decrease. Now remember that these insured charity dollars are not subject to the cost to charge ratio, so they have a dollar for dollar impact on the line 30 totals. The MACs were verifying that those insured charity dollars were only associated with coinsurance, deductible, or copay amounts. And I think it's pretty clear from this analysis that there were some significant findings in that area in conjunction with the audit or when the hospitals prepared the logs for review. So this next slide represents the change in line 22 patient payments. And as you can see, 401 had revised totals. And while the dollar amounts were relatively small in comparison with total UC costs, there were dramatic decreases in patient payments equating to over a 90% decrease for both uninsured and insured payments. Now in 2017 and future cost reports, only patient payments associated with charity discounts granted in a prior year are to be recorded on line 22. So for virtually every hospital, patient payments should have decreased significantly starting in 2017 compared to the prior years. And just like insured charity discounts, those patient payments are not subject to the cost to charge ratio. So any change has a dollar for dollar impact on that line 30 cost total. And so now with this slide, we see that a little over 1,400 fiscal years were revised for total bad debt. Again, the change was massive with a $2.1 billion representing a little more than 7% removed from the S-10 reports. I think a more robust bad debt review in the S-10 audits is the biggest cause for the decrease. We know from our experience of reviewing filed S-10s from this time period, some hospitals were still reporting bad debt from their provision, which in some cases could be considerably different than the actual patient bad debt activity. We also know that while Medicare bad debt is more thoroughly reviewed before filing, the non-Medicare bad debt typically can go through little to no review. Then at the time of the audit sampling, there can be significant audit findings based on either a systemic issue with how bad debt is reported or some other reason such as lack of documentation. So in summary, what do all these numbers mean in actual UC reimbursement? Because I don't want that to get lost with all the changes on S-10. This table summarizes the results of the changes for these 1,539 providers we just walked through. There was a total of 1,050 hospitals that saw their line 30 decrease, while 489 saw an increase. And as you can see, the reduction in dollars outweighed the increases as the average line 30 change was a reduction of $660,000. So using historical values to project what that might look like in a future UC payment, that $660,000 reduction equates to around a $171,000 decrease in a future UC payment when you keep all other values constant in that calculation. And so there was some wild swings still with these audits as we saw over 300 multi-million-dollar negative adjustments to line 30, with the largest coming in at $92 million reduction. We also saw some sizable increases, with the largest at over $47 million that equates to about a $12 million pickup in future UC reimbursement. Our assumption is a lot of the cost reports with increases to their line 30 came from revised logs that were sent in at the time of audit and did not necessarily match the filed cost report. It'll be interesting to see as we move towards fiscal years where at least charity detail had to be provided at the time of filing, and we get through further audit rounds, whether the MACs will continue to allow logs that don't match the filed report. And I think, as Mike will cover in our next section, it's clear with CMS's new proposed rules that they are emphasizing that all the detail, along with all the necessary information, will be required at the time of filing. So hospitals need to ensure that they are doing everything they can to make sure the values are accurate and up to date at the time of the original filing. And kind of with that, before Mike gets into the new reporting requirements, I think we have our next polling question.
All right, so our fifth polling question is up on your screen now, and we have been receiving a lot of comments and questions in the Q&A, so we're going to use this time again to let Mike address some of those while you respond to the polling question.
So the one I've got for this time is did we hear you correctly? Providers have already received S-10 audit requests for the next wave of audits. Yes, you did hear Jonathan correctly on that. I know it seems like you're just now taking a breath from the process that was just completed at the end of last year, and for some of you actually into the beginning of this year. I don't have specific information with regard to how each MAC across the country will be approaching this, but we have had at least one example where that request has been submitted to providers. So the process is beginning again, even if in early stages for just some people right now.
All right, and here are the results to the polling question.
Well, this is certainly something that. Oh, go ahead, Jonathan.
No, go ahead. I was going to probably say the same thing you did. I think it's kind of across the board where I think a lot of people are still trying to wrap their heads around the audit that just finished and whether I need to go back and make some changes. So you have a significant portion that still said yes, and even a bigger one that said I don't know. And I think hopefully we're providing some clarity and some things to think about as you look towards maybe amending that or updating those before they get audited.
Okay, with that, let's shift gears a little bit and start talking about what's coming up for the future. And in the interest of time, I'm probably going to move through this pretty quickly, but it's something that I think I'll advise you now and at the end to spend some time looking into. I know you can read these exhibits for yourself, but I think it's important to cover most of the points because when you go through it, it's a bit confusing. So for cost reporting periods beginning on or after October 1 of 18, CMS mandated that hospitals include in their filed cost report a patient-level detailed listing of dish days, but they didn't include any parameters on what should be included in that listing. And now, fast forward to changes presented in the Federal Register in November 2020, and CMS has clarified what it's looking for and is implementing a new exhibit called Exhibit 3A for cost reporting periods beginning on or after October 1 of 2020. And here's a copy of the exhibit, and I want you to notice first at the top that there'll be a separate exhibit required for each column of line 24 or 25 on S2. So for example, you'll have a separate exhibit for in-state Medicaid paid days, in-state Medicaid eligible unpaid days, out-of-state Medicaid days, out-of-state Medicaid eligible unpaid days, HMO days, and labor and delivery room days. So that's one change. You'll have separate exhibits, and they must tie to the days reported on that line and those columns in the cost report. And if we kind of go across the 18 lines, the first is a group of columns 1 through 7, and this is mainly information that comes from the Medicaid recipient's bill, and it includes your typical demographic information like name, date of birth, gender, which is not really determinant on whether you qualify for Medicaid program for DISH or not, a Medicaid ID number, and dates of service. And then columns 8 and 9 request the patient's medical record number and the patient accounting number from your internal system. Column 10 requests the applicable state plan eligibility code that the patient qualifies under. Now, this is something that has routinely been required during your audit when you receive an audit sample and you have to provide a response to that, but it's not something that generally had been required up front when you filed your cost report. Now, column 11 requests the number of eligible days reported in the cost report. And per the instructions for this Exhibit 3A, again, the sum of the days entered in this column must equal the number of days reported on Worksheet S-10 for the line and column selected. And in accordance with their previous instructions, if these exhibits aren't completed properly, it could result in an unacceptable cost report and it be rejected. Column 12 requests information regarding labor and delivery room days, which are defined as days which a maternity patient is in the labor and delivery ancillary area at midnight at the time that the census is taking. And there's more information on exactly how that gets reported in the reimbursement manual, Chapter 22, Section 2205.2. Columns 13 and 14 request insurance company or other payer information, both for the primary payer and for the secondary payer related to the patient. And then something else that's typically handled when you mine this information, columns 15 and 17 request information regarding Medicare eligibility for the dates of service that you've got stated in columns 6 and 7. So is the patient eligible for Part A, not eligible, Part B, not eligible, and if they're not eligible, you would just leave these blank. So you can see here, this is quite a comprehensive request and a departure from what you would normally send in with your as-filed cost report, and includes some data elements that maybe in the past you've provided at audit, but certainly never when you filed the cost report. So I would take a look at this and compare to your process and begin thinking about how you would compile this information. So with this, let's go ahead and move on to information related to S-10. Now, there are a number of issues that were addressed in this proposed change to S-10 that I would term as more substantive changes, and then those related to reporting on the cost report. So let's first talk about some of the issues not related to the new exhibit, which I'll talk about next. Now, while it should be obvious for those of you that have been through an audit, CMS clarified that only written financial assistance policies can be used as support for write-offs. However, CMS does not mandate a hospital's eligibility criteria, so there's no so-called wrong answer if something that is properly included and approved in your hospital policy. But they've made clear through a change in the reimbursement manual that this has to be written. It's not something that you can try to substantiate through practice, but it's not supported by your policy. And while this was a battle early on, CMS does allow uninsured discounts, and now the manual is clear on that point. And there were some early fights on trying to get that done. And as Jonathan mentioned earlier, write-ups can only originate from medically necessary services, so you've got to be careful with things like non-covered charges if they're non-covered because the services were not medically necessary. Where a hospital seeks payment from HRSA as part of a provider relief program, The charges related to those patients must be excluded from reporting on S-10. Now, I think the biggest change relates to the type of patient data that can be reported. Previously, data for the entire hospital operation was reported on S-10. And in fact, certain data automatically flowed from other portions of the cost report, like the cost to charge ratio from Worksheet C. Now data should include only the acute portion of the hospital, no subunits. So now, for example, you'll actually have to compute a cost to charge ratio and enter it on S-10 off of the data that's reported on Worksheet C, because it will not flow automatically. And then to clarify, I'm not going to go through all these, but this is a slide that will clarify what should be included on each line in terms of uninsured and insured patient payments and bad debts. It's pretty consistent with what we've talked about during the audits, but I wanted to include it just to make sure everyone was clear on what should be included. So let's do the hard part. Let's actually flip to the exhibit, and let me go through this, because I think there's some things in there that I really want you to see so that you can think about for the future. Columns 1 through 5, and this relates to charity care, and there's a separate exhibit for uninsured and insured patients. Columns 1 through 5, again, include demographic information, name, admission, discharge, and patient account number. Column 6 is applicable to the uninsured listing and reflects whether the patient was uninsured or insured but not covered. And there's an indicator that you'll have to include there in order to distinguish. And more specifically, for the insured not covered patients, those are patients that have insurance, but the insured does not have a contract with the hospital. Patients that had insurance and the services were medically necessary but not covered for the stay, and patients that had insurance coverage but the patient exhausted their benefits. Column 7 requests the insurance carrier's name. Column 8 is for the Medicare beneficiary identifier, which is sort of the new Medicare number. Column 9 is for the patient's Medicaid number. Column 10 is to denote whether the patient was approved for charity pursuant to a hospital's written policy, written charity or financial assistance policy, and a yes or no answer is applicable there. Column 11 is where you would denote which policy, whether it was a charity policy or a financial assistance policy. Column 12 is to report total charges for just uninsured patients. Column 13 is to report deductible coinsurance and copayment amounts for just your insured patients only. Column 14 is for non-covered services, and that is if the hospital policy permits you to include those as a charity write-off. And then the next set of columns will sound familiar to you, because these are the type of items that were requested to do the reconciliation during the audit. And the descriptions pretty much cover them. So I'm going to zoom down pretty much to column 20 where they come together. And column 20 is gross charges from column 12 minus reductions in columns 15 through 19. And don't get tripped up, because the description for column 12 is not consistent with how you should treat pro fees. So you should watch out for that. And then from there, they're doing something interesting. They're comparing actually the amount of the write-off to what the result was to that reconciliation. And the presumption is where you end up is after you apply these other deductions to the patient account, you end up with the charity write-off or something very close to the charity write-off. And then after that, they request a write-off date, any patient responsibility charges, and then any payments received. So I know we covered this fast, but I want to give you a sense that there's a lot of information here, some of which is different than the reconciliation sheet you provided during the audit. And now for me, a question is, are you going to be providing two different spreadsheets, one when you file the cost report and one that you have to complete as part of the audit. So this is something I think that to really spend some time on and get engaged with. And then the last is now also a listing of total bad debts, which wasn't included in the original request that was effective for cost reporting periods beginning on or after 10/1 of 18. But this is applicable now. It's got much the same information, demographic information from the patients, service dates. This also asks for primary and secondary payer from the patient, information regarding their service, whether it was inpatient or outpatient, total charges, physician charges, and then any payments to get you down to the write-off, amount. And again, careful attention should be paid to this schedule, as the end result should be the actual write-offs. But this exhibit does that through a calculation. So I think it's going to be interesting to see how this gets populated, and you run through the calculation, because column 16 is a calculation, and how does that match your actual write-off? So you're going to have to be doing some additional work as you prepare this schedule and reconcile it for submission with the cost report. So with that, I think, Amy, we'll turn it over to you for, I believe, our last polling question.
Yes, so this is our last polling question. Do you think you can produce data under the Paperwork Reduction Act requirements? A, yes, we should be able to. B, no, we need help. C, not sure. Or D, NA. And once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE Progress window. And also wanted to remind you, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. And we'll leave this up for a little bit longer to make sure everyone gets their full credit. All right, here are the results.
Well, I think this is certainly great news from those of you that feel like you're going to be able to do this. This is a heavy lift on your part. I know there's been an initiative to try to do something about this. It's always interesting when CMS requests substantial new information under the guise of paperwork reduction. But it's never too late to start to look at this. And in fact, that's really kind of the theme for our final comment here is take lessons learned that from the audit that you experienced, and also from the information that we've shared here today, which is sort of a cross section of audit experience that we went through working with every MAC in the country, and go ahead and get started right away looking at these new provider reimbursement manual requirements and the population of these new schedules. I certainly wouldn't wait till it's time to prepare the cost report to get focused on that. So we're near the end of time. I don't think we're going to have time to take questions. We will follow up with each of you that asked a question and reach out to you. And I know Amy will be providing a recording and the slides. And I think there were some other comments about maybe getting a little bit more information with regard to the answers to the questions that Heather and Jonathan went through. So we'll work to do that as well. If you want some additional information about how things look from a trending perspective for you on either your S-10 reported data or Medicare DISH, or whether or not you may qualify for the potential SSI realignment analysis, here's some resources that you can use to reach out to us, and we'll be happy to help you with that. And then here's some additional resources that we have from a pandemic COVID-19 standpoint that that you can access that we hope will be of some benefit to you. And I think with that, we won't have time for questions. I will turn it back over to you, Amy, for your final thoughts.
All right. Well, thank you. Thank you, Mike, Jonathan, and Heather, for a great presentation today. And for the audience, if we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. If you're not able to, a copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. And thank you for joining our webcast. We hope you'll join us again next time.